Good afternoon, ladies and gentlemen. Welcome to the JKH Investor Relations Webinar for the first quarter of 2023-24. My name is Gihan Kure. I am the Deputy Chairperson and Group Finance Director. I'm joined by Krishan Balendra, who is the Chairperson and CEO, and the two of us will take you through today's webinar. The format for today's webinar will be where Krishan will initially give an overview and an update on the macroeconomic situation, and thereafter I will take you through the financial performance for the first quarter and some analysis therein. And then after that, we will open up the floor for a Q&A session. If I may remind you that if you have any questions, please enter it into the Q&A tab at the bottom of your screen. With that, I'd like to commence proceedings by inviting Krishan to provide an overview.
Thank you. Thank you, Gihan. Welcome all to our quarterly earnings webinar. Just to begin on the macroeconomy, we are continuing to see normal day-to-day activity for the population across the country as well as for business. Quite a change from what we had about a year back, but of course in the last few quarters we have seen this improvement and life is very much normal on the ground in Sri Lanka. We have seen inflation coming down sharply from the peak of over 70% in September last year. Inflation was closer to 10% in June and expected to be in single digits and keep going down from June onwards. Interest rates have also been coming down. We had the announcement of the domestic debt optimization recently, which is the first step in the overall restructuring of the country's external and internal debt, which is due to be completed by the end of the current calendar year. Interest rates from the peaks of around 30% are now around the average prime lending rate today is around 17%, and with inflation now coming down rapidly, is expected to come down further. The currency has also stabilized. In fact, it has appreciated from the lows of about 365 to 370 rupees to the dollar. The currency today is at about 330 to the dollar. Again, a reflection of the increasing confidence and stabilization of the economy. The central bank has also revised their growth rate for the second half of this year and are expecting better growth overall for calendar year 2023. With the stabilization and improvement in the economy, we are seeing a gradual pickup in consumption, in particular in our soft drinks and ice cream business, and Gihan will talk more about that during the presentation. We have seen volumes improving in all three segments, but in particular in soft drinks and frozen confectionery in the last few months. Tourism is also recovering. Post-COVID, we saw a pickup early in 2022, but then with the economic crisis, we saw tourism numbers falling sharply again. It took some time to recover because of the bad publicity that we had around the economic crisis. But today, if you look at the month of July, based on the first 23 days of arrivals, we expect that tourist arrivals for July will be closer to 150,000 arrivals compared to about 215,000 in 2018 pre-COVID and prior to the 2019 Easter bomb attack. So a recovery to about 70% of pre-COVID arrivals. Room rates are still a little lower, but also getting better than pre-crisis and pre-COVID. And based on our forward bookings, we expect that the winter season starting in December, that arrival numbers will be almost back to pre-COVID. And room rates may be a little lower, but very encouraging that we are seeing this kind of recovery from where we were a few months back. On our major projects, the fit out at Cinnamon Life of the hotel and mall area is continuing, progressing very well. As you know, the 2 apartment towers and the office tower are completed and being handed over and getting occupied right now. On the gaming, as we have said in our quarterly statement, we have been engaging over the last few quarters with some leading international gaming operators. They have visited the property, their engineering teams, their due diligence teams, and we are now close to a final agreement with a leading international gaming operator to lease out and operate the space at Cinnamon Life. As we have been saying, we expect when Cinnamon Life is operational, the hotel, mall, and gaming space is operational towards the end of calendar year 2024, that it will be transformational for Colombo as a tourist destination. It will be the only integrated resort with gaming facilities in the South Asian region and one of a handful in all of Asia. On the West Container Terminal, again, progress is very positive. You would have seen some of the images, and you will see some recent images in the investor presentation. All the dredging work is completed, the reclamation is completed, and we are very much on target for completion of phase 1 by end 2024 or January 2025, where we expect to begin operations of phase 1 with a capacity of about 1.6 million TEUs, and full completion, phase 2 and the entire terminal to be operational by end of calendar year 2025. So that was a quick update on the macro and some of our big projects. I will hand over to Gihan to run through some slides on our recent quarter.
Thank you, Krishan. So I will take you through the presentation and try to leave enough time for Q&A. Just starting off with the quarter. So for Q1 2024, the group did an EBITDA of 9.2 billion compared to an EBITDA of 13 billion in the previous year. This represents a decline of 31% from what we witnessed the last year. Just keeping in mind that the achievement of a 13 billion in Q1 last year was, despite the circumstances, was quite an exceptional performance in the context of the annual EBITDA performance of 45 billion. So the 13 billion itself was quite a significant number. As you can see on the slide here, you can see the performance of the transportation business, and as we go through the numbers, we'll talk you through it. But we did have an exceptional quarter in transportation as overall bunkering oil prices were very high. The port did very exceptional numbers as well. And this was also aided by the fact that the rupee depreciated sharply. And given that these are dollar-denominated businesses, the translation of that also affected positively the performance. Whereas in this quarter, and we'll talk you through some of these details, the rupee, as Krishan did mention, has appreciated around 15% from what we witnessed on average for the last quarter. So there are some sort of negative impacts as a result of that, particularly on the businesses that have the dollar-denominated revenue streams. We did have our consumer foods business coming off, but our leisure business also did come off compared to last year with the performance in the Maldives. Whilst we did record the top-line performance, there have been challenges in terms of cost, particularly with fuel prices going up. In the Maldives in particular, there's been a lag of the fuel price reductions coming through, and as a result, that has translated to some negative impact, though that should start normalizing. I will take you through the rest of the performance, so I won't spend too much time here. This is just our annual EBITDA performance, and like I said, in the context of a 45 billion for the total year, the 13 billion for Q1 was quite a strong performance, and it's in that light that you see the comparative quarter also having a more significant decline. If you look at it through the 5 quarters, starting with Q1 last year to Q1 this year, you can see that the performance at 9.2 billion is in line with what we saw in Q2, slightly lower than Q3 and 4, but against, like I said, the record performance in Q1. If you look at the bottom of the screen, at the exchange rates here, you can see that the exchange rate on average for Q1 was at around 350, and then of course, like Krishan said, spiked to around 365, 370 in Q2, Q3. But in Q1, we saw this sort of coming down to around 310. So there's around a 15% appreciation, which is what I referred to earlier in terms of the impact on some of the dollar-denominated businesses. Now, on the other side, whilst the input costs also can and will benefit from this appreciation, there generally tends to be a lag effect, but we have started seeing that, and as we get to some of our consumer businesses, I will talk you through some of those impacts as well. In terms of finance costs, for the quarter, it was at 5.3 billion, a significant increase against Q1 of last year as interest rates increased, as well as the translation impact of the dollar debt as well. But this also includes around 750 million rupees coming from the convertible debenture issued to Fairfax, and this is the notional non-cash interest component, which wasn't there last year, but also the fact that this is non-cash. But 5.3 billion includes the totality of this as well. And if you look at the different businesses, whilst you can see a lot of the businesses, as we have invested in working capital with the rates increasing, have seen an increase compared to last year, the main increase comes from the holdco itself, which is under other. Just looking at the quarterly analysis of finance costs, if you look at it, we spoke earlier of the Q1 to Q1 comparison, the year-on-year comparison. But if you look at the middle column here, you'll notice that for Q4, we've seen this, and I think what we spoke of last time as well is that the finance cost is likely to have peaked, and we will start seeing this sort of plateau. And that's exactly what we're seeing, where it's sort of plateaued, come down marginally, but we should hopefully start seeing that coming down further. You can also see the interest rates. So last year, rates were at around 17.5%, and this year, whilst rates have come off, it's still higher than last year at close to 21%. But you can see how it's come off from the peak of close to 25%. So we're definitely starting to see that impact. And the latest rates that you're seeing right now, like Krishan mentioned, is in the region of 17%. So you can see the type of impact it's had. So this will definitely positively impact our total finance expense. Having said that, we do have dollar-denominated debt as well. So whilst the rupee interest rates come off, and that will have a benefit on the rupee portfolio of debt, the dollar portfolio of debt, of course, won't see that commensurate benefit. And of course, it will depend also on what the exchange rate is in terms of the translation of that. But as we saw before with the exchange rates that we are seeing, whilst the rupee has depreciated from around the 310 level to 325, those levels, it's still lower than what we saw at the 360 to 370 range in Q2 and Q3 last year. Looking at the PBT in terms of the comparative, there's been a significant decline in the PBT, but we've also just included here the fact that there was an exchange gain of around just over 10 billion rupees in the last quarter of last year, in the first quarter of last year. And that's the impact you're seeing, which has driven the PBT in terms of that non-cash exchange gain. But if we adjust for that, then there is still a decline. but it's a comparative number of about 4.6 billion versus a 1.7 billion. And we'll, of course, you see that impact coming through, but mainly from transportation. If you look at the slide, you'll see the first line where transportation has declined, as well as the leisure impact. And I will take you through the details of the specifics there. Before we get into the sectors, just a quick snapshot on some of the key financial indicators. In terms of total debt levels, it's come down very slightly, and net debt is at around the same level that we were at the end of March in the last quarter, with our net debt to equity being at around the 30% mark, which as we've indicated before, is quite comfortable. In terms of some of the other initiatives across the group, we've seen carbon footprint and water withdrawal increasing. This is a sort of more of a revenue-based impact that we've had, but a lot of initiatives that have been done on this. Continuation of a lot of the other initiatives under the One JKH brand as well. And here we've launched different programs, including programs for understanding needs assessment on persons with disabilities and so on, as well as some other initiatives in relation to LGBTIQ community as well. Moving on to the transportation business, we saw overall volumes increase, and I'll talk you through that in the following slides. But before we get into that, just a quick snapshot. Krishan already spoke of the progress on the WCT. So the images here that you see, the side-by-side comparison, just shows you what this was just barely over 6 months ago to what it is today. And if you look at a closer picture, you'll see the type of work that's happened. So right now what's happening here is the quay wall construction is progressing. The dredging works are pretty much done, and we made a lot of progress and on track towards completion by end of next year. In terms of performance of SAGT, we've seen overall volumes being slightly higher than last year, a marginal growth. But I think in terms of revenue and profitability, what's more important in a sense is that we've seen the mix change, where the transshipment proportion has increased and the domestic has come down from 13% to 10%. And this has a slightly more disproportionate impact on revenue, given that domestic cargo is at a higher revenue than that of transshipment cargo. So with the import restrictions that we've seen in the country and the slowdown of the economy, naturally we've seen a reduction in domestic volumes, which is what has translated to this change in mix. So whilst overall volumes have been strong and we've sort of seen it being fairly robust and growing, particularly over Q3 and Q4, where we were at just over 400,000, overall profitability was impacted as a result of this, as well as a slight decline in ancillary revenues, though again it's much higher than we've seen in the past. But last year, again, we saw a peak of ancillary revenues. What's also impacted overall performance here, like I mentioned earlier, is the fact that we've seen the rupee appreciate by around 15%, and this has affected both the bunkering business volumes as well as the ports business. I must also just point out, whilst I'm on SAGT, that SAGT did have a credit on deferred tax, which is not adjusted here. So the figure is around 700 million rupees, which is within the 2.4 billion that you see in terms of EBITDA. Moving on to the bunkering business, we saw a decline in volumes of around 19%. But again, if you look at last year, we saw significant growth in volumes driven by the core bunkering business, but we also started seeing domestic volumes coming in with the liberalization that was there. It was a temporary one that lasted for about a year, given all the challenges that the country had last year, but volumes were boosted by that and margins as well. So there's those combined impacts that have resulted in this reduction in performance. But again, just to reiterate the fact that it's against a fairly exceptional performance in Q1 of last year at 4.5 billion rupees. Moving on to the consumer foods business, if you look at the volumes, we've seen a continuation of the decline in volumes. But having said that, it's improved a lot. As Krishan mentioned, we've seen Q1. So if you look at the decline, we've seen beverages decline by only 3% compared to almost 20% in Q3 and 40% in Q4. And just taking you back to looking at Q1 of last year, it was a very strong quarter where we saw, of course, on a comparative basis, if you look at the previous year, it was pandemic affected, but still we saw very strong volumes in ice creams and beverages. So it was a very normalized quarter with strong absolute volumes. So against that base, we've only seen a decline of 3% on the beverages and 10% on the frozen confectionery. And if you look at it in terms of the sort of run rate we've actually seen volume growth coming in for the month of June. So if you look at the quarter, yes, it's a decline. But if you look at April to May to June, we've seen progressively things have gotten better. And even in the month of June, we've seen that sort of growth coming through, which is quite positive. And right now, in the 3 weeks or so of July, we've also seen that same momentum continuing. Whilst it may be too soon to really say that that is a shift we are seeing, I think on the ground, like Krishan said, we've seen a lot of positives on the macro front with interest rates coming down, with the DDO a lot more certainty, and the exchange rate also appreciating. So there's a better confidence that's coming through, and you're starting to see that translate into this sort of consumption. If you look at the overall performance, EBITDA grew, if you look at it on a quarter-to-quarter basis. So if you look at Q3 to 4 to Q1, we've seen EBITDA recover gradually. And as we've said, as we've seen some of those input cost increases, some of the issues on the exchange rate, the shortages on material, working capital investments, all those things coming through and overcoming that, we've seen that translate to better numbers, though it's a gradual recovery. So whilst when we look at it versus last year and this year in terms of the Q1 performance, and we see a significant impact, I think we are definitely seeing the numbers head in the right direction, not only from a volume perspective, but just even from a product margin perspective with all the price corrections we've taken and the stabilization or decline in some of the input costs. So with that, what you're really seeing is that the EBITDA margin, which sort of sunk to a low of 6% in Q3, has progressively and gradually, but still it's heading in the right direction, where it's now reached around 9%. So I think overall, whilst this business has faced these challenges, we are quite confident that if we see this sort of same momentum continuing, that volumes will recover, and with the product margin recovery as well, that the business margins and overall profitability will recover. In terms of some of the indexed prices of our raw materials, just to quickly show you in terms of beverages, we've seen that sort of decline from the peaks that we've seen. It's plateaued quarter to quarter. There's a very marginal increase here on the sugar, but it's just to give you a sense that we are still seeing that sort of decline. And if you move to the next slide, you see on ice creams in particular, where margins have been a little more challenged, and there's been more of a lag effect actually in ice creams. We are seeing that sort of impact on things like key inputs like skim milk powder coming down quite sharply, as well as sugar. So if you look at the total profitability of the consumer foods business, we've actually seen the beverages business EBITDA being strong or comparable with last year, and the challenge was more with the ice creams business. And also, though it's a smaller business, it also did contribute quite significantly to the decline in our convenience foods business. So here you can see that the ice creams business, with this sort of declines that we are seeing in these input costs, whilst there has been a lag, we are starting to see that margin recovery in ice creams, which will or should translate to strong profit recovery as well, as long as the volumes continue to head in the right direction. Moving on to our retail business, we saw strong same-store sales growth in Q1 of this year, like we've seen throughout. And unlike the previous 2 quarters, that's Q3 and Q4, where a lot of that same-store sales was driven by growth in ABV, this time around, we've seen the ABV contribution to growth being lower. And as you can see on the slide, we've seen the footfall growth being close to 15% compared to the ABV growth at 7%. So as we've seen throughout, other than in Q4, where footfall was very marginally up, we've seen very strong footfall growth throughout, which is still a very positive factor that's been helping drive the business. Now, in terms of margins for this quarter, we've seen margins at 6.3, which is a decline in terms of the run rate. But having said that, we've taken a lot of action. So the top line is growing, but some of the challenges have been centered around the input costs, with particularly the electricity costs being revised quite significantly in the country. There's been quite an impact there, as well as some of the staff costs. The business has taken a lot of initiatives to manage these, in terms of we've had a fair bit of solar investments or renewable investments that have also helped reduce that impact over time on the HLP, the cost. But also in terms of staffing and productivity, we've also undertaken some initiatives. So we expect to see margins starting to sort of recover from these numbers as some of those initiatives start to take effect. In terms of the breakup of the numbers, like I spoke earlier, we've seen footfall growth being quite significant. So we expect this to continue. ABV, of course, has still grown. We've seen the June inflation number being at around 10%. So the ABV growth at 7% is largely in line with that. And we've seen the sort of WOP, which is the weight of purchase or number of units, with consumer behavior still sort of showing a slight decline, but not as significant as we've seen before. So hopefully we would start to see a reversal of these numbers, and the growth can be driven by footfall growth, as we've seen. Moving on to leisure, we've seen continued recovery at a gradual pace. But if you look at what's happened in the month of July, from June, we've seen the total arrivals into Sri Lanka being just over 100,000. And this is the number up to the 23rd of July. So it's roughly for 3 weeks with a week to go. So that's a very positive trend that we've sort of already gone over what we've done for June. And I think the bookings and the momentum that we are seeing is quite strong. Krishan already touched on the type of momentum we are seeing, and that's quite encouraging for the Sri Lanka part of the business. If you look at the Maldives again, the numbers have been quite strong. Here again, the numbers are up to the 24th of July, but again, slightly based on these numbers would be better than June. And of course, looking at last pre-pandemic levels or even last year should be around that mark. So the overall numbers into the Maldives have been quite strong. So it's less of a sort of top line issue that we are seeing. This slide just shows you how that momentum is. And if you look at it point to point, you'll see that overall the occupancies have been largely in line. Just looking at Colombo, we've seen occupancy, if you look at it compared with Q1 last year, it's increased, and the ARR is also higher. But the EBITDA margins, because of some of those cost impacts and the appreciation of the rupees, slightly down compared to being flat last year. In Sri Lanka, again, occupancy has been higher, so that's heading in the right direction. ARRs are marginally lower, and the EBITDA margin is largely in line with Q1, keeping in mind that Q1 is typically the off-peak season. Of course, we are coming off a very low base, but as these numbers get better and we head into Q2 and 3, we should start seeing these get better. But like I said earlier, the challenges of some of the costs have been there, particularly heat, light, power again. with the significant increases in electricity tariffs in the country. But now there has been an amendment to that which should help the leisure business quite materially, as well as, of course, staff costs have also increased. But as the top line grows, absorption of those costs will get better. In the Maldives, we've seen occupancies and ARR by and large in line with Q1 of last year, but the margins, as you can see here, have come off if you look at Q1 to Q1 because of the facts that I mentioned earlier. But with leisure, as you can see here, really a lot of the sort of main impacts and the positive impacts come in Q3 and Q4. And as we head into that peak seasons in the next couple of quarters, we expect performance to recover. This is just some images on Cinnamon Life. I think Krishan already spoke on gaming, so I won't spend too much time here, but just to reiterate the fact that we've made very good progress discussing options and agreements with the leading gaming operators, and we are sort of getting to the final arrangements of looking at structures and an agreement. In our property business with Trizen, we've seen a few new sales coming through, and that's encouraging given where we were over the last couple of quarters. So we had 2 units being sold compared to what we saw the last couple of quarters where we had hardly anything being sold. So that's positive. We've seen a lot of inquiries and leads as well, and with interest rates coming off very sharply, you're seeing people now looking at different asset classes. And as we've said before, we've been patient. We've already sold 650 odd units, and we expect to see demand picking up in line with the interest that we are seeing and the progress of the project, as well as we get closer to completion towards the end of this year. With Cinnamon Life, again, we haven't seen any new unit sales, but we've seen a lot of traction and interest. And as we've said before, as the totality of the project gets closer to completion, and with gaming also getting that much closer to finality, we think that can be a significant boost and catalyst for demand for apartments at Cinnamon Life. Finally, with financial services, overall performance, we've done well compared to Q1 last year. I must, however, remind you that Q1 last year did have impairment pertaining to the foreign government securities at Nations Trust Bank. So that base is affected based on that. But overall, we've seen a very steady performance in the financial services industry group, driven by both the insurance business and the bank. As you all know, the domestic debt optimization, the announcements were made on what the program entails. And with that, we've seen both the banking industry and the insurance industry being excluded. And whilst we've spoken before of the various scenarios we've done on liquidity and capital impacts and so on, both industries have been excluded, which of course then gives a lot more stability and confidence in terms of the outlook. In terms of foreign government securities under the DDO plan, there is a framework that's provided. NTB has sort of provided higher than its peers, so there could be a positive impact coming through once we sort of get finality on the exact accounting treatment of some of these aspects. So overall, financial services, we've seen the momentum that we've seen over the last many quarters continuing through, and the outlook also will be that much more positive, given that the uncertainty of the DDO is not an overhang on the industry, both industries anymore. So that brings us to a conclusion on the presentation. I'd like to open up the floor for questions. And again, just to remind you, if you have any questions, to please enter it into the Q&A tab at the bottom of your screens. Krishan, there's a question on gaming. With regards to the gaming license, is the plan to use an existing license or whether it would be a new license, and how long that process could typically take?
Yeah, it would depend also on the choice of the operator. So I think both options are open. The regulations do allow for a new license, but we may work with one of the existing licenses as well. So at the moment, a final decision hasn't been made. It would depend a lot on the preference of the operator, because it is the operator who will use the license to operate.
I think we sort of covered this, but maybe a little more clarity, Krishan, in terms of the forward bookings that we are seeing for the Sri Lankan hotels and the destination management business.
Yeah, the forward bookings, if you look at it week on week, the increase we have seen over the last 2 months has been very encouraging. So there is a significant increase in the forward bookings compared to even 3-4 weeks ago, what we saw just last week, which was why I commented that we think that by December, arrivals will be back to pre-COVID. And what is very encouraging is that we are seeing the Western European markets recovering. The initial recovery, of course, came from Russia late last year and early this year, but then we saw India recovering, and now China is picking up. China so far in July has been the third biggest market, but looking at the forward bookings, the Western European, UK, France, Italy, and so on, the forward bookings are encouraging.
Thanks, Krishan. There's a question on how Cinnamon Life is classified into the leisure segment and whether there's any affiliation with KHL, that's Keel's Hotels. Essentially, this was earlier classified under the property industry group because it was a real estate sort of development and being developed. And of course, there being an integrated resort, there are different aspects of the development, from the apartment towers as well as the commercial spaces. So once those have now got completed, and as we sort of have now started doing the pre-opening work for the hotel side of it, we've now decided to move Cinnamon Life into the leisure space, because essentially the recurring revenue streams and profitability from Cinnamon Life essentially will be under the hotel, the conferencing, and the retail spaces, but all that will be, given that it's an integrated property, be reported under the leisure industry group. So really, it's just a classification of where we report this, as opposed to any connection with Keel's Hotels or any of the other entities, but it's just a question of how we report it under the industry group verticals. There's a question on just understanding LMS bunker volumes market share, Krishan, about the fact that Hambantota has done significant amount of volume in the first half, but just in terms of how LMS volumes have been and the market share that we have.
Yeah, actually, Hambantota has done significant volumes, but Hambantota, the operator of the storage terminals, doesn't do bunkering themselves. They are supplying the existing bunker operators who have been operating for the last so many years in Colombo and even off Hambantota and off other parts of the country. So that hasn't, the increase in volumes in Hambantota hasn't impacted our market share. In fact, we just like the others, we are procuring from Hambantota. So our market share remains the same. So it is not directly impacted by increases or decreases in volumes at Hambantota.
As Cinnamon Life comes on soon, there's a question on whether we are reviewing the portfolio lest we become more asset heavy. We've spoken of this before, Krishan, in terms of the leisure portfolio, but in terms of what options we are looking at and any.
Yeah, we've been talking about this for some time. Our expansion strategy for Cinnamon Hotels has been an asset-light strategy. Cinnamon Life is an integrated resort. It's a property development, apartments, the mall, and of course the gaming. But with the rest of the hotel portfolio, we are looking at an asset-light strategy, and we are working towards that. Any new properties is likely to be where, like Cinnamon Red in Kandy, we will have a minority equity stake or no equity stake at all, but with long-term management. And with the existing portfolio as well, if there is an opportunity to be more asset light to fund our future expansion, we would look at it.
Thanks, Krishan. There's a question on commenting on the net dollar position of the group. So just to put this into context, if you look at Cinnamon Life, because it is a company that's the functional reporting currencies in US dollars, we exclude that because that has its own hedge, given that asset and liabilities are in dollars. But if you exclude that, JKH is still long on dollars, so we have a net dollar positive position, which is why we saw a marginal exchange loss coming through for the quarter because of the appreciation of the rupee. Now, having said that, we had a far stronger or a larger net dollar position, but given some of the outlook and what we were expecting, we did convert some of those and took a treasury call in terms of how we manage the balances between higher rupee funding costs versus dollars. And because we did that, I think we minimized any negative impact as a result. But overall, still, we've gone on the basis that we try to maintain as far as a natural hedge as we can in terms of the IFC dollar loan that we have as well. So right now we are still long on dollars, but not by a small amount. In terms of, I think there's a related question in terms of the current dollar liquidity available. So we still have, like I said, a strong dollar position, and that dollar position will help us to manage the investment commitments that we have with Cinnamon Life as well as the West Container Terminal. So with Cinnamon Life, we've got under $100 million or more to go in terms of equity, and of course we have residential sales also that's due to come in. And in terms of some of the other projects, as we've said before, with West Container Terminal, we are looking at roughly around another under $50 million more to go in terms of our equity commitment into that project. But those are the two sort of more heavy capex items which are now sort of running through the latter part of the cycle. There's a question on the price growth in the manufacturing segment. So based on the type of price adjustments we've taken across the portfolio, we've seen significant top line growth, and that's been largely driven by price increases. Offhand, I can't give you an average number, but you can see that despite the volume declines that we've seen, not this quarter, but even if you look at the previous quarter where we saw volume declines of 30 to 40%, there was still top line growth, which means the sort of price adjustments were largely in line with inflation at the time, or maybe even in that ballpark. There's a similar question again. Has there been any upward price revisions in CCS during the past 6 months? Yes, there have been more sort of in the sort of back end of that. Of late, we haven't sort of taken significant price increases. It was more in Q2 and 3 that we took those significant price increases. There's a question in terms of whether there's a targeted EBITDA margin. I think we've seen what are more normalized EBITDA margins that we've seen in the past, and we hope that it'll get to those sort of numbers, whilst I can't sort of comment that there is an exact target, because it will be a question of how we progressively get there. Krishan, there's a question on Maldives arrivals were higher while occupancy was down slightly. Are we seeing intense competition there?
Yeah, it's just also the mix in the arrivals. Pre-COVID, China was the single largest market into the Maldives, and China has not contributed at all except for the last 2 or 3 months, and that also small numbers. So a lot of the gap due to the lack of Chinese arrivals has been made up by an increase in arrivals from India. So we've seen similar overall arrival numbers to pre-COVID. And a lot of that is because despite China being virtually zero, it's because of the arrivals from India. And you're seeing resorts mushrooming even in the inhabited islands, which are slightly sort of more mid-end and lower-end resorts at a different pricing point. So as Chinese arrivals recover and as the Western European arrivals also increase, you're seeing a similar situation to what we have seen here, that with the high cost of flights, this summer season has been quite weak from the long haul markets. But we think that by the winter season, the European numbers will also recover. And of course, China will continue to recover now from the small base we are in. So, the overall number you're seeing in the last few months is a little misleading because of the mix, but we think the mix will normalize over the next few months, which should translate to better occupancy and rates.
There's a question on the leisure EBITDA and how much of that was spent on cinema and life. So we had around just over 200 odd million on cinema and life, because as we have staffing costs, of course, right now we are not recruiting, given that we are still some time away, but there's a core team that's there, as well as there are now marketing and promotional related expenses which do not get capitalized into the project, that are getting expensed, and that's the impact of what you see overall. Earlier, Krishan, we said that local resorts reach break even at around 45 to 50% occupancy in terms of this question, and based on some of the changes we've seen in cost structures, and of course with the rupee depreciation helping as well, what sort of occupancy is needed. I think right now we are sort of still, because ARRs haven't really increased, we've seen the numbers in resorts being negative, but naturally we will need a slightly higher occupancy to break even now. But it will also depend on what level the rupee is at. So I think the question was what sort of occupancy will be needed. I think roughly at around 60%. We would be breaking even, but again, it depends on, like I said, the exchange rate.
Correct. And our expectation is that occupancy should be back to pre-COVID levels in the upcoming winter season. Room rates will be lower, maybe 10 to 20% lower. So you will need a higher occupancy. Rupee costs have gone up significantly, but of course the rupee has devalued as well. And the first quarter is quite misleading because we had lower arrivals compared to pre-COVID. We've had lower room rates, and of course, May and June are the worst 2 months for tourist arrivals anyway. It's the peak of the off season. So I think about 60% is the right number.
There's a question staying with leisure, Krishan, on an insight between the mix of domestic and foreign bookings in the coming months. We just spoke of forward bookings, but just in terms of the mix.
So pre-COVID, if you look at the Sri Lanka resorts, the occupancy from the domestic segment had increased to as much as 25% if you took a full year. This came down sharply even as the foreign arrivals picked up because of the fuel issue and the fuel quotas. But with the fuel quotas now being increased and the availability issues being eased, we are seeing now again over weekends that domestic occupancy picks up quite strongly. And so that as well, we think now over the next few months, we have that domestic segment will contribute more. It won't go back to 25% because it's simply more expensive than it was pre-COVID, but it will get better than what we've seen in the last few months. So that's the occupancy in our resort hotels. In the city hotels, domestic business is the banqueting, the events, and the F&B business in the restaurants. And that has been very strong. Despite a substantial increase in prices, we have not seen a fall in the number of covers. And in fact, in the last month or so, we are seeing an increase in the number of covers. So July is looking good, and so is the month of August for the events and banquets, but also the restaurants in the city.
Okay, thanks. Krishan. Just moving on to the consumer business and retail, there are a couple of questions about margins, margin recovery in the business, as well as based on the price revisions, whether there will be more to come. So I'll try and sort of just answer those in one go. I think we already spoke about the margin impacts that we've seen over the last couple of quarters and what measures we've taken to address that. So significant price increases, of course, being one, but we also, as we've shown through the deck, we've seen the input costs coming off, the appreciation of the rupee, reduction in interest rates. All those have combined to help reducing input costs, and we're starting to see that. So if you look at, again, just going through our presentation from Q3 to 4 to now Q1 this year, we've seen margins heading in the right direction despite year-on-year volume declines. So as volumes also start to recover and we get the benefit of operating leverage, we will start seeing that translate to better impacts on margins overall. But product margins have now recovered and are heading towards sort of in particularly in the soft drink side, we expect to head towards normalized sort of volume. So then normalized margins, and of course it then depends on what type of volumes we see. With ice creams, like we said before, there's been more of a lag effect in terms of the input cost declines, but again those are also now starting to translate to come through the P&L. Overall, I mean, whilst the market has seen some downward price revisions, that is also maybe a part of the tactical play in terms of pack sizes, competitive activity, and so on. So the question was whether there will be more price revisions. Whilst there can be in certain instances, SKUs and so on, we don't expect to be en masse on the basis that there have been significant, as you can see, significant margin impacts, and as a result, we don't expect to see across the board downward price revisions. But again, it all depends on how the cost structures and where the rupee is. But based on the outlook of what we see, we don't expect those to move significantly that would warrant sort of price reductions at a portfolio level. There's a question on any move to discuss the restructuring of the final part of the Cinnamon Life loan. I'm not too sure whether I've got this question right in terms of the context of it, but we already had sort of refinanced Cinnamon Life in 2021 and extended the loan. It's a 5-year loan. A lot of the repayments are back-ended, so there's no further sort of restructuring or anything that needs to be done with that loan, other than the fact that based on the timing and so on, you have certain project milestones and things like that, which we need to adjust based on the revised timelines of the project. But it's not a restructure of the loan or anything of that nature that needs to be done. There's a question on the outlook for NTB in the coming quarters, and a question on the asset quality review. There's the asset quality review, there's no outcome of that to be discussed right now. It's the other banks that were initially going through it, so there's nothing to comment on that at the moment. The outlook for NTB is quite positive, as we've maintained over the last couple of quarters, in terms of liquidity, exposure to foreign government securities, all that we were better placed. Now, of course, there's no uncertainty of a DBO on the entirety of the industry, which also does help. So overall, I think we still expect to see positive impact as NTB has sort of looked at their whole ALM. So their NIMs have been quite strong and solid throughout. The overall industry will still face challenges on NPLs, but hopefully as we start seeing business recovering, early signs of recovery, hopefully that should lead to better cash flow generation for our customers, and therefore help with stabilizing NPLs across the industry, not just with NTB. Krishant, there's a question on whether the Gaming Act is necessary for large operators to make inroads to Sri Lanka. I think the framework is already there in terms of the gaming regulations, but maybe any comment you can.
No, there is the regulations that were gazetted in September last year and passed in Parliament in December last year are adequate for most of the leading operators that we have engaged with. So we don't see an issue with the framework that is currently in place. Of course, similar to other jurisdictions, it can evolve and become stronger, which is something any leading operator would welcome. But what is in place now is adequate for most of the parties that we have spoken to.
Thank you, Krishant. I don't have any further questions that have been raised. So therefore, we can conclude today's proceedings. Thank you all for your participation and active engagement throughout this webinar. The webinar proceedings will be on our website, will be posted in a couple of hours' time. So if anyone wishes to watch it again or share it, the link will be available. Thank you once again very much for your participation. Have a good day.
Thank you.